Okay, chapter 2 for investments. We're going to talk about different asset classes and different types of financial instruments, and how they work, how they're valued, how to figure yields, those kinds of things. Okay, so asset classes. The first one we're going to talk about is fixed income. We'll also talk about equity and derivatives later. So the very first one we're talking about is money markets. So money markets are very short-term, highly liquid, and relatively low-risk debt instruments. Can contain several different things, several different financial instruments within money market accounts. They're usually very short term. They usually have high liquidity, which means they can be turned into cash quickly. They're usually relatively low risk, and they often have large denominations. Okay, example, we have a T-bill, Treasury bill. These are issued by the federal government. Commonly, the denomination is $10,000 or $1,000. The maturity length, anything from we have 4 weeks, 13, 26, or 52 weeks. So we got obviously 6 months. We got 1 month, 3 months, 6 months, and they do it by week, obviously, but roughly 1 month, 3 months, 6 months, and a year. Liquidity is high. They can be traded and turned into cash almost instantly. There's a very good market for it, and you can get rid of it anytime you want to. So it's an investment that if you want to be able to turn it into cash as soon as possible, then you can buy T-bills. The other thing is it is got almost no default risk because it is backed. You see the issue here is the federal government. The federal government, if they need more money to pay your T-bill, they would just print more money to pay your T-bill. Not that they do that all the time, but they could. So there is no default risk at all. Interest type is discounted, which means that you pay less for it than the face price in the first place, kind of like if you remember a discounted note, where you pay less than par value and then you return the par value afterwards. The interest is in the difference between what you paid and what you received back, and the received back is what the par value is. So taxation, it's owed for federal. It's usually exempt. T-bills are usually exempt for state and local taxes, but that would depend on the state specifically. So it goes on. It doesn't show the math on here, but the math is in your chapter on page 27 and 28. It talks about how to figure out what a bank discount method is on something like this. So they use the October 12th maturity. And I'm, like I said, on the bottom, the last paragraph, page 27, and then over to 28. So, for example, the October 12, 2017 has 177 days to maturity. So that means in 177 days, they're going to pay back the par value of the bond. And the yield under the column labeled ask is 0.895. This means the dealer is willing to sell the bill at a discount from face value of 0.895. So we can take that 0.895 and then we can adjust it for the amount of time of a year. So 0.895 times 177, but I want to do the portion of the year, so I'm going to divide 177 by 360. So 177 divided by 360, 0.491, multiply that times 0.895, which was the ask price, and I get 0.44. Now, what that really is 0.44%. Okay, so 0.44% is what that number really comes to. So then, if we want to figure out, this is different math, so I don't want to confuse you. Then, if we want to figure out so then what you could buy that one for, we need to take that 0.44%, so 0.44%, which is really 0.0044, and we multiply that by the par value to see how much of a discount rate it's going to be. And they use the par value of $10,000 in here. So the discount is going to be $44. So now I can take that from the face value or the par value to find out what the selling price is. So it's a $10,000 par value bond, or T-bill. I'm going to pay $9,956 for it, and then in 177 days, I'm going to receive $10,000. So I'm only paying $99.56. I'm receiving $10,000 for 177 days, and that's how we figure to calculate the yield on that. Okay, how to figure out a bank discount rate. If you have the amount that you're actually going to pay for it. Rather than having an asking price, if we know what we're paying for it in the first place, we can take the par value. They put the 10,000 in there, but they put the par value minus the market price of the T-bill, and then take the 360 divided by the number of days to get what the return is. So for example, if the asking price is $98.75, that's the one they do in here, $9,875. That means, and it's a 90-day T-bill, then that means the yield would be 5%. All right, CDs or certificates of deposit. Is a time deposit with a bank. It may not be withdrawn on demand, which means it locks your money up. So the problem with that is that means that, you know, if you need that money, that's not as liquid as the T-bills we just talked about, which usually means it will pay a little bit better interest rate wise. Generally, the more locked up your money is, just like risk, it has a relationship with the amount of return that you're going to receive. If you do try and get it out early, usually there's heavy penalties and fees, and you don't receive interest, and it's just kind of a bad idea. So depository institutions, so banks and that type of thing, any denomination $100,000 or more, varies. Typically a 14-day minimum as far as maturity goes, but it can be kind of anything. Liquidity is relatively high for CDs if it's less than 3 months, meaning you can buy and sell the CD. So you have a CD and you can't receive that money out, but you can buy the rights to receive that money out, or sell your rights to receive that money from the bank. So it is fairly liquid in that way. It's just not liquid in the way that you can get your own money from the bank itself. Default risk, it's the first $250,000 is FDIC insured, so there's really no default risk on anything under that, over that. It kind of depends on, it's dependent upon the bank. Interest type is an add-on. Okay, so it's not discounted. So if I put $10,000 in a CD, it grows from $10,000 up. It doesn't take a discount up front like the prior one we just looked at. And then taxation is usually owed to federal, state, and local levels on CDs. This book jumps around a little at this point because it goes all the way to page 32 in the chapter to talk about the bond market. So you can see what happens with the spreads on CDs and T-bills when we have market crashes and financial crises. They tend to spike up a lot. Same thing when there was oil prices in the 70s and 80s. So whenever you see those types of spikes, you can see that obviously we're in turmoil. So what that means is that people are shifting risk. People are shifting from riskier to safer investments, and that's when that spread becomes higher. Commercial paper, a different form of certificate deposit. Usually this is something from a larger organization. Minimum on these is $100,000, but they are traded in mutual funds, so you can still get your hands on some if you don't have $100,000 to invest. The maturity is a maximum of 270 days. It's usually more like 1 to 2 months. This is usually a method that larger companies will use to get short-term financing when they don't want to have to go to the bank and go through the entire process of getting a loan. So they will have commercial paper certificates of deposits, but then several of them or multiples of them. Default risk is unsecured, rated, and mostly high quality. So it's unsecured, which means if that company goes under or bankrupt, there is not collateral. It's not collateralized, so you won't receive anything. They are rated like bonds are rated. That means basically they have a credit score. Okay, have a likelihood of being paid back. So you can get higher default risk ones, but most of the time, most companies that use commercial paper are usually companies that are doing it just for the speed of it, not for they can't get money anywhere else most of the time, which means usually they're pretty highly rated and mostly high quality. Interest type is discount again, where we go backwards. We say this is what the value of commercial paper is, and we go backwards and pay the discounted amount to purchase it and then receive the par value when it comes out. Taxation is usually federal, state, and local. There is a newer thing called an asset-backed commercial paper. If it's an asset-backed commercial paper, what that should mean is that this unsecured goes away. If it's really got an asset behind it, that should mean, assuming that everything is done correctly, that there is some sort of collateral behind the commercial paper itself. Okay, banker's acceptance. Banker's acceptance is an order bought to a bank by a customer to pay a sum of money at a future date, typically within 6 months. So it's really kind of like a post-dated check, effectively. So the bank endorses the order for the payment as accepted and assumes responsibility for the ultimate payment to the holder as at the acceptance. So at this point, the acceptance may be traded in secondary markets like any other claim on a bank. Bankers' acceptance are considered very safe, and they allow traders to substitute the bank credit standing for their own. So kind of really similar to a kind of like a cashier's check in a lot of ways, because the person who's responsible for that is the bank at that point. So when the purchaser accepts the draft, it becomes a contingent liability of the bank, not the individual. All right, Eurodollars are dollar-denominated deposits at foreign banks or foreign branches of American banks. By locating outside the United States, these banks escape regulation of the Federal Reserve. Despite the tag euro, these accounts need not be European banks. They are in practice of accepting dollar-denominated deposits outside the United States. So they usually pay a higher interest than U.S. deposits. So effectively, you're using outside banks outside the United States with higher interest rates. Okay, federal funds. Federal funds are the commercial banks and the Federal Reserve Bank kind of getting together. So generally speaking, banks use the money that they've received as deposits from their customers to lend out. But if they don't have enough, or if they only have, the Federal Reserve requires a certain amount of money to be kept in reserve at each of those banks, if they are approaching that number and they can't lend money out because they have only their reserves left, and they can borrow money from the Federal Reserve, usually at the prime, what we call the prime interest rate, which is a very key interest rate for the economy. And then they can re-lend that out to other companies. Most mid-sized and smaller banks have enough money, they don't have to borrow from the Fed too frequently. But larger banks that deal in very large transactions, it's not uncommon for them to have to borrow federal funds. LIBOR market, London Interbank Offer Rate, is a premier short-term interest rate quoted in the European money market that serves as a reference rate for a wide range of transactions. It's designed to reflect the rate at which banks lend money among themselves. So the LIBOR rate is kind of like the European version of the Fed rate. Since we have a Federal Reserve System that lends money to our banks, this is the international version of that. It's the rate at which the banks lend to one another in the European market. And it's also the base rate for a lot of loans and derivatives. Okay. Repurchase agreements, a short-term sale of security and a promise to repurchase them at a higher price. It's a collateralized loan. Many RPs are even overnight. So the 1 month is about as long as they get for the term on a repurchase agreement. A reverse repurchase agreement is lending money and obtaining security title as collateral. Yeah, lending money and obtaining security title as a collateral. So that's, again, a collateralized loan. So it's a mirror image. The reverse repo is a mirror image of a repo. So the dealer finds an investor holding government securities and buys them with an agreement to resell them at a specific price at a future date. Okay, broker calls. Call money rate applies for investing and buying stock on margin. Loan may be called in by the broker themselves. The money market funds and things that happened in the credit crisis, they grew too large and too quickly. Mutual funds, money market mutual funds, they had their own crisis in 2008, the Lehman Brothers themselves. The reserve primary fund broke the buck, effectively affecting the value of the dollar in a big way. The run on money market funds ensued, so people tried to invest heavily in it, especially when they thought it was a safe investment, when everything was kind of going terribly, and they didn't have enough assets to back it, so it became unsecured and became also a lower likelihood of actually getting paid back. The U.S. Treasury temporarily offered to insure all of those money market funds through the FDIC. Okay, we'll stop there for now and continue with the next video.